We've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices.
With Bitcoin pulling back from recent highs, speculation is mounting over whether the market has already peaked. While some analysts warn of an impending bear market, renowned investment strategist Lyn Alden sees things differently. Looking at historical cycles and on-chain data, she argues that Bitcoin still has room to climb before hitting a true market peak. A major factor in her outlook is global liquidity. Bitcoin historically thrives when liquidity expands. With the U.S. inching toward rate cuts and potential shifts in monetary policy, more capital could flow into risk assets like Bitcoin. Additionally, while signs of euphoria exist, current on-chain metrics don't indicate the extreme overvaluation that typically precedes prolonged downturns. Beyond market cycles, Alden points to a broader trend: Bitcoin's growing role as a reserve asset. The recent announcement of a U.S. strategic Bitcoin reserve, even if limited to confiscated holdings, marks a symbolic shift in how Bitcoin is perceived. No longer just a speculative investment, Bitcoin is being treated as a legitimate financial tool. This raises the big question: will other countries follow suit? If sovereign nations start accumulating Bitcoin to hedge against monetary instability, we could see an unprecedented wave of institutional and governmental demand, further driving its adoption. So, are we entering a bear market, or is Bitcoin's biggest rally still ahead? In a recent interview, Alden breaks down current crypto market conditions, the future of Bitcoin, and how the Trump administration's policies could shape the markets and broader economy in 2025 and beyond.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So far it's in line with my base case, which was that they probably would have ring-fenced their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that, and that's what the executive order said to do. Basically, take those coins and put it into a separate reserve and don't sell them. I think the slight upside of the executive order to do it was that the Treasury's authorized to explore budget-neutral ways to accumulate Bitcoin a little bit more. I expect that to be kind of low numbers, but maybe I'll be surprised to the upside. And then they also, I think, did a good job of separating out Bitcoin from the rest of the cryptocurrency space, because they put those, again, from like forfeitures and reserves, forfeitures and seizures, they put them into a different bucket, and is treated differently, because the Bitcoin one, by executive order, they're not allowed to sell it. Whereas by the same executive order, the Treasury Secretary can use their judgment to figure out what they want to do with other coins, which can include selling them. And I think that's good, because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, it's kind of just treating that as a separate, less important pool of capital, and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years. I try to give conservative targets. And for example, I was pretty sure we would hit 100K, and we did. I thought maybe we would hit it in 2025. It was interesting that we touched it late last year. What I tend to monitor instead is levels of euphoria. So instead of saying, it's going to go to this price by this year, there's a couple of things I look at. One is Bitcoin tends to correlate with liquidity conditions. It generally does better in conditions where liquidity is going up, which is in some ways another way of saying debasement's going up, which is different than just CPI. And then the other one is like when you look at some on-chain characteristics, one of the big ones I look at is market value compared to on-chain average cost basis. Because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about when I'm able to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like to put it in real estate terms, if there's like say 20 houses on a street, and like none of them have sold, bought or sold in years, and one of them finally changes hands, and it's 50% higher than its last price. Generally speaking, the value of that the whole street now is higher, even though only 5% of the houses, 1 out of 20, have basically now moved the price, the perceived price of all those houses. The same thing happens in a more liquid sense in Bitcoin, which is there's a bull market around the margins. It's tightly held. Some influx of capital comes in. Bitcoin goes up really quickly. But when you look at how many coins actually changed hands, it's usually a pretty small percentage in that initial bull run. And then you kind of like want to see that become more real. So for example, on that house street, you'd want to see another house sell at like a similar price, and maybe a third house before you say, okay, this is probably like something approaching the new price of the street. We can have more confidence in it. And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio, because basically the cost basis, the average cost basis, is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices.
Lyn Alden challenges the common fear that Bitcoin has already peaked, countering claims of an extended bear market. She sees no clear signs of the extreme euphoria that typically signals a cycle top. Instead, she argues that Bitcoin's recent surge to all-time highs, followed by periods of consolidation, suggests a mid-cycle phase rather than the end of the bull run. Historically, Bitcoin's cycles have been fueled by rapid price increases driven by retail and institutional FOMO, often pushing valuation metrics into overextended territory. However, on-chain data indicates that this cycle has not yet reached the speculative excess seen in past peaks, supporting Alden's perspective that Bitcoin's rally may still have room to run. Beyond market sentiment, macroeconomic conditions reinforce this restrained optimism. Unlike previous bull markets that thrived on abundant liquidity and aggressive monetary easing, Bitcoin's latest cycle has unfolded in an environment of higher interest rates and tighter financial conditions. Despite these headwinds, Bitcoin has still managed to set new highs, suggesting stronger organic demand and resilience compared to past cycles. This structural shift indicates that Bitcoin is maturing as an asset, potentially becoming less dependent on loose monetary policies to sustain its upward trajectory. In her interview, Alden also explores the impact of the Trump administration's economic policies on financial markets and the broader economy in the years ahead. With the landscape shifting, she highlights key factors that could influence Bitcoin's trajectory, including potential shifts in monetary policy, global liquidity trends, and increasing institutional adoption.
this is kind of the outcome of having the dollar be monetized, to be treated as like global money, whereas other monies don't really have that same usage. So most currencies trade when they have like various fluctuations against each other. They mostly trade on things like what's their trade balance doing. So they generally, if they run trade deficits for a while, often it will correct against them, usually not pleasantly, but that'll kind of fix that structural imbalance, as well as interest rate differentials. And you know, that's kind of how the majority of currencies function. And what's interesting about the dollar is that because the dollar is held by most countries around the world, often in the form of U.S. treasuries, but also like literally deposits in U.S. banks, deposits with the Fed, as well as U.S. capital markets, it basically means that in addition to those normal things, the dollar also has an extra monetary premium on top of it. And so it kind of makes the dollar overvalued on a trade balance basis. And it's also used as the global financing currency. So it'll often be the case that, say, a firm in France, helps finance an entity in Brazil. It'll be with dollars instead of either of their currencies, just because it's the leading network effect. It's the ledger that multiple different entities can use. And the offset of that is that basically everybody in the world needs dollars because they have dollar liabilities. They invoice things in dollars. And the way that they get dollars is they basically overvalue the dollar. And therefore, American import power gets very strong. We send dollars out into the world, and our export power is weak, especially for lower margin things like manufacturing. We're still good at tech and healthcare and finance, but not so much manufacturing compared to many other peers. And this over time, it sounds like a good thing at first. We're sending dollars and we're getting goods in return. But the other way to point out, and he has that full kind of capital cycle, is that when we send the dollars out there, foreign entities come back and reinvest it into our capital market. So what we're actually sending out is ownership in our companies and our property compared to the rest of the world. And we're basically buying depreciating goods by sending them parts of our appreciating assets. And it also has an imbalancing effect because if you work in the Rust Belt, the reason it became the Rust Belt is because we deindustrialized. Whereas if you work in capital markets or if you just happen to have a lot of assets, you've generally benefited from this arrangement. You can travel the world because the dollar is so strong. Your assets, the whole world's investing in the same assets you are. So they're generally up and to the right. And over decades, you start to get rising populism, rising discontent with that approach. And so I do think it makes sense that they are trying to basically reverse course out of it. And the only part that I might push back on in those charts is that the administration has a little bit of a two-sided aspect here, which is they have all these kind of detailed views of what they want to do for trade realignment, but they say that they want to keep the dollar as a global reserve currency. So, for example, if they saw that chart that says, okay, instead of the foreign sector investing in treasuries, they're going to invest in gold or Bitcoin or whatever, there are elements in the administration that would say that that's not necessarily our goal, whereas there to be other elements in the administration that say that is our goal. And I think that's probably one of the challenges they have to navigate.
Because the challenge there being we don't want to lose. We need the dollar to weaken, but we don't want the dollar system to kind of fall apart either.
Yeah, essentially, there's a trade-off by being the global reserve currency issuer. Is basically you get a huge sanction power, and the government it has much easier time finding itself. So, for example, Brazil has similar deficits on a percentage basis than the U.S., but that gives them a currency problem because there's not this like structural demand for their currency, whereas the U.S. Government can kind of get away with a longer runway there. And then the other side is that industrial base issue. And so, generally speaking, they try to maximize both, but it's often hard to do so. And if you look at parts of the administration, like they propose things like taxes on reinvesting capital in the U.S. So like if a foreign entity wants to hold treasuries, they might actually talk about discouraging that above a certain scale by basically putting taxes on some of those assets and say, okay, you can hold treasuries, but we're going to take back some of those basis points and make that a little bit less attractive for you to do, to maybe discourage you from doing it. But then there are other parts of the administration that are saying, hey, we like stable coins because it'll get treasuries out into the world more and increase demand for treasuries. And those things have some degree of conflict with each other.
So what do you how do you think this plays out then? What are you thinking?
My expectation is that this is probably going to be a very long process, much how the
deindustrialization.
I think the deindustrialization took decades to occur and reach a scale that became like politically among the biggest things, that to the point where an administration would start highly prioritizing it. And I think this is an initial set of first steps to say, okay, we're at least talking about the problem, doing steps to address the problem, and I think that there probably will be fits and starts along the way. And it'll take, decades to gradually unwind that and kind of reindustrialize.
Lyn Alden's insights offer a compelling view of the evolving financial landscape. For decades, the US dollar's role as the world's reserve currency provided the United States with unique advantages, including strong import power, cheap borrowing, and a global financial system built around the demand for US asset. However, this dominance has come with a cost. While Wall Street and asset holders thrived, industries crucial to American strength, such as manufacturing, production, and infrastructure, were neglected. Now, for the first time in decades, policymakers are openly acknowledging this imbalance and taking steps to address it. Simultaneously, global capital flows are shifting. Countries that once reinvested their trade surpluses into U.S. treasuries are increasingly exploring alternatives, such as gold, Bitcoin, or direct investments in real asset. The rise of stablecoins, while maintaining short-term demand for treasuries, only underscores a larger issue. Trust in the dollar-centric financial system is eroding. Nations and investors are diversifying their reserves not only for profit but for security. This signals a transition where the dollar's supremacy is no longer guaranteed, and decentralized assets like Bitcoin are emerging as significant players in the global financial system. The pace of this transition, whether slow and controlled or rapid and chaotic, remains uncertain. However, one thing is clear. Those who recognize these shifts early will be best positioned for what lies ahead. If you found this analysis insightful, don't forget to like and subscribe. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.